Wall Street banks made billions selling silver futures at $30 per ounce throughout 2025. Their research reports told clients that silver was adequately supplied, that industrial demand was stable, and that prices would remain range-bound between $25 and $35. Then Friday the 13th happened. Physical silver traded at $127 in Dubai, while their own COMEX contract showed $73, a 70% price disconnect, and not a single major Wall Street firm warned their clients this was coming. Why? Because they were on the wrong side of the trade, and admitting the truth would have cost them everything. Let me tell you what Wall Street won't say publicly about Friday the 13th. The major investment banks knew there was a physical supply problem months before January. They had the data. They had analysts tracking refinery output, shipping schedules, and inventory levels. But they kept publishing research telling clients everything was fine. In November 2025, Goldman Sachs published a commodity outlook projecting silver would average $29 in 2026. Their analysis cited adequate mine supply, moderate industrial demand growth, and limited investment buying. The report made no mention of Chinese export restrictions. It ignored the COMEX inventory depletion that was already underway. It dismissed concerns about physical premiums as temporary regional anomalies. JP Morgan's December precious metals report was even more dismissive. They projected silver would trade in a $26 to $32 range through the first half of 2026. They told clients that any price spikes would be short-lived and represented selling opportunities. Their recommendation was to maintain underweight positions in precious metals and focus on industrial commodities with stronger fundamentals. Morgan Stanley published similar guidance. Their January 2nd outlook, released less than 2 weeks before Friday the 13th, suggested silver was overvalued at $31 and recommended profit-taking for any clients who had gained exposure in late 2025. Every single one of these reports was wrong, not just slightly wrong, catastrophically wrong. And it wasn't because these banks lack smart analysts or good data. It was because telling the truth would have exposed their own positions. Here's what Wall Street won't tell you. The major banks are massively short silver through futures and derivatives contracts. JP Morgan alone has held short positions estimated between 80 and 120 million ounces at various points over the past 5 years. HSBC, Scotia, and other large banks have similar exposures. These short positions made sense when banks could control the paper market and source physical metal whenever needed. But by late 2025, that control was slipping. Chinese refineries weren't cooperating. COMEX inventories were falling. Industrial buyers were demanding physical delivery instead of accepting cash settlements. If Wall Street banks had told clients the truth in November or December, they would have triggered exactly the crisis they were trying to avoid. Imagine JP Morgan publishing a report saying physical silver supply is critically tight. COMEX may not be able to fulfill delivery obligations, and prices could spike dramatically. Every client would immediately buy silver. That buying pressure would force prices higher, which would increase the losses on JP Morgan's own short positions. So instead, they did what large institutions always do when trapped in bad positions. They tried to talk the market down. They published reassuring research. They told clients to sell rallies. They hoped the problem would resolve itself before anyone noticed. The internal communications at these banks tell a different story than their public research. In late December, several major banks quietly advised their largest hedge fund clients to reduce short exposure to silver, not through official research reports that retail clients would see, through private phone calls and invitation-only briefings. This is standard Wall Street practice. Big clients get honest risk assessments. Small clients get research designed to support the bank's trading positions. It's legal as long as the research has disclaimers about conflicts of interest, but it's fundamentally dishonest. What makes this even worse is that some Wall Street executives were personally positioning for the crisis they were publicly denying. SEC filings show that several senior commodities traders at major banks increased their personal holdings of physical precious metals in the fourth quarter of 2025. They knew what was coming. They protected themselves, but they kept publishing research telling ordinary investors that silver was overvalued and should be avoided. Friday the 13th exposed this dishonesty in the most public way possible. When Dubai physical prices hit $127 while COMEX showed $73, everyone could see the gap. Retail investors who followed Wall Street's advice to avoid silver or take profits watched from the sidelines while those who ignored the banks made 200 to 400% returns. The bank's response has been predictable. Instead of admitting they were wrong, they're now saying the Friday the 13th spike was a temporary anomaly caused by panic and illiquidity. They're telling clients that prices will normalize and the paper market will reassert control. But here's what they won't say. The fundamental problems that caused Friday the 13th haven't been solved. China still controls refining. COMEX inventories are still depleted. Physical premiums are still running 15 to 20% over paper prices. The crisis isn't over. It's just beginning. Wall Street also won't discuss the massive losses their trading desks took on Friday the 13th. When you're short silver at $30 and prices spike to $75, you're facing catastrophic losses on every contract. Some estimates suggest the major banks collectively lost over $2 billion on precious metals positions in January alone. These losses will eventually show up in quarterly earnings reports, buried in trading revenue numbers. But the banks won't connect those losses to their failed silver predictions. They'll blame market volatility or unexpected geopolitical events, anything except admitting they were wrong. The real story Wall Street won't tell is about the structural change in commodity markets. For decades, Western financial institutions controlled price discovery through futures markets. They could set prices through paper trading regardless of physical supply and demand. That system is breaking down. When physical silver trades at 70% premiums to paper prices for hours, without arbitrage closing the gap, the paper market has lost its function. Wall Street won't admit this because their entire business model depends on controlling price discovery through derivatives and futures. Now let me explain the short position crisis that Wall Street is desperately trying to hide from public view. This is the real reason they couldn't warn clients about Friday the 13th. The major banks build short positions in silver as part of their market-making operations. When clients want to buy silver futures, banks sell them contracts. This creates short exposure for the bank. Normally, they hedge this by buying physical metal or taking offsetting long positions. But over years, some banks let their net short positions grow to enormous sizes. Why would they do this? Because shorting silver was profitable when they could control the market. If you can suppress prices through paper selling and prevent physical delivery demands, short positions generate steady income. You collect premiums from selling contracts, prices stay flat or decline, and you never have to actually deliver metal. JP Morgan perfected this strategy. Analysis of CFTC data shows they built short positions exceeding 100 million ounces at times. That's more than 10% of annual global mine production. They would aggressively sell futures contracts whenever prices started rising, capping rallies, and protecting their shorts. This worked for years. From 2011 to 2024, silver prices generally declined or traded sideways despite growing industrial demand. The paper market kept prices suppressed even as physical fundamentals tightened. Wall Street made billions from this trade. But by late 2025, the strategy was failing. The banks kept selling paper to cap prices, but physical buyers kept demanding delivery. COMEX inventories couldn't support both the bank's short positions and the delivery demands. Something had to break. Wall Street won't tell you that they knew their short positions were at risk months before Friday the 13th. Internal risk reports at major banks flagged precious metals as a concern in October and November, but closing those positions would have required buying back millions of ounces, which would have pushed prices sharply higher and locked in massive losses. So they tried a different approach. They attempted to scare physical buyers out of the market through aggressive paper selling. In early January, just days before Friday the 13th, banks sold massive amounts of futures contracts during low liquidity Asian trading hours. The goal was to trigger stop losses and create a cascade of selling that would push prices below $60. It didn't work. Physical buyers absorbed every dip. Industrial consumers who needed metal for production viewed price drops as buying opportunities. The attempted manipulation failed, and it cost the banks credibility they'll never recover. What Wall Street really won't discuss is the counterparty risk they created. When banks are short 200 to 300 million ounces collectively and can't deliver physical metal, they're essentially running a fractional reserve scam. They've sold something they don't have and can't obtain. In a normal market, this would trigger default and insolvency. But COMEX rules allow cash settlement of contracts that can't be physically delivered, so banks can avoid technical default by paying cash instead of delivering metal. But this destroys the entire premise of the futures market. If a silver futures contract doesn't guarantee actual silver, it's worthless as a hedging tool. Industrial buyers can't manage supply chain risk with contracts that might settle in cash. This is why physical premiums spiked so dramatically. Buyers lost faith that paper contracts represented real metal. The banks are now trapped in a slow-motion squeeze. They can't cover all their shorts at once without causing prices to explode. But they can't maintain the positions indefinitely because monthly delivery demands keep draining available inventory. Every month, they have to deliver some metal or pay cash settlements at elevated prices. Either option increases their losses. Wall Street research reports aren't mentioning any of this. They're not explaining to clients that the largest banks are sitting on potentially tens of billions in unrealized losses on precious metals positions. They're not warning that these losses could impact bank stability if prices continue rising. Instead, they're publishing analysis suggesting silver is overvalued at current levels and recommending clients avoid the sector. This serves the bank's interests by potentially reducing buying pressure, but it does nothing to help clients understand the actual market dynamics. Let me expose the delivery deception that Wall Street is hiding behind carefully worded legal disclaimers. This is how they're avoiding accountability for the Friday the 13th disaster. COMEX futures contracts are supposed to be deliverable. That's the fundamental difference between futures and pure financial betting. When you buy a silver future, you have the legal right to take delivery of physical metal. The seller has the legal obligation to deliver that metal. But Wall Street has created a system where delivery is technically possible but practically impossible for most participants. The minimum delivery size is one contract, which represents 5,000 ounces. That's roughly 155 kilograms of silver. For a retail investor, taking delivery requires arranging transport, insurance, vault storage, and paying various fees that can add up to thousands of dollars. So most small investors never attempt delivery. They just roll their contracts forward or settle in cash. Wall Street counts on this behavior. They can sell unlimited paper contracts knowing that 95% of buyers will never demand physical metal. But this system breaks down when large institutional buyers or industrial consumers start demanding delivery. And that's exactly what happened in the months before Friday the 13th. Solar panel manufacturers needed silver for production. They couldn't get reliable supply from Chinese refiners due to export restrictions. So they started buying COMEX futures and demanding delivery. Electronic component makers did the same. Investment funds that manage physical-backed silver products needed metal for their vaults. Suddenly, delivery demands overwhelmed the system. COMEX warehouses that were supposed to have metal ready for delivery started reporting delays. They cited logistics issues, paperwork problems, and scheduling conflicts. But the real issue was simple. There wasn't enough metal to fulfill all the delivery requests. Wall Street won't admit this publicly. Their official position is that COMEX operated normally throughout January and all delivery obligations were met. Technically, this is true, but it obscures what actually happened. Many delivery requests were settled in cash instead of metal. Banks would contact buyers and offer cash settlements at prices above the contract price. For example, if you had a contract for delivery at $70 and the bank offered to settle in cash at $78, many buyers accepted. It was an $8 per ounce profit without the hassle of taking physical delivery, but some buyers refused cash settlements. They wanted metal. And this is where the system really broke down. Banks had to source physical silver at market prices to fulfill these delivery demands. In January, that meant paying $85 to $95 for metal in physical markets to deliver against contracts sold at $65 to $70. The losses on these forced deliveries were enormous. But Wall Street won't disclose them in detail. They're buried in broader trading results and attributed to market volatility rather than failed market-making strategies. What's even more deceptive is how Wall Street is now using the delivery crisis to justify even more restrictions on physical settlement. Some banks are lobbying COMEX to increase minimum delivery sizes or implement additional fees that would make delivery even less practical for smaller buyers. Their argument is that excessive delivery demands create operational challenges for the exchange. But the real motivation is protecting their ability to sell paper contracts without having to deliver metal. They want futures to become pure financial instruments disconnected from physical commodity markets. Wall Street also won't discuss the warehouse games that happened during the crisis. COMEX-approved warehouses are private businesses, often owned or controlled by the same banks that trade futures. When delivery pressures mounted, some metal mysteriously moved from registered status to eligible status. Registered metal is available for delivery against futures contracts. Eligible metal is stored in COMEX warehouses but not available for delivery. Moving metal from registered to eligible reduces the supply available to meet delivery demands without actually removing it from the warehouse. This is legal under COMEX rules. Warehouse operators can change metal status for various legitimate reasons, but the timing was suspicious. Just as delivery demands peaked, millions of ounces moved to eligible status, reducing pressure on the banks that were short. Part 4. What Wall Street knows about what's next. Now let me reveal what Wall Street's internal analysis actually says about where silver goes from here. This is very different from what they're telling retail clients. The private briefings that major banks give to their largest hedge fund and institutional clients paint a much more dire picture than public research reports. I've spoken with people who attended these briefings in late January and early February. The message was clear. The silver market has fundamentally changed, and paper prices are increasingly irrelevant. Bank strategists privately acknowledge that COMEX has lost its role as the global price setter for silver. Physical markets in Dubai, Singapore, and Zurich are now determining real prices based on actual supply and demand. COMEX prices represent what traders are willing to pay for paper contracts that may or may not deliver metal. This creates a bifurcated market. Paper traders who want financial exposure use COMEX futures. Physical buyers who need actual metal pay premiums in regional physical markets. The spread between these markets will persist and likely widen because arbitrage can't function when physical delivery is unreliable. Wall Street's internal models project that physical premiums will stabilize around 12 to 18% over paper prices under normal conditions. During periods of stress or high delivery demand, premiums could spike to 30 to 50% like we saw on Friday the 13th. For industrial consumers, this means budgeting for much higher real costs than COMEX futures suggest. A manufacturer looking at $75 COMEX prices needs to budget $85 to $95 for actual metal delivered to their facility. Wall Street won't say this publicly because it undermines the legitimacy of futures markets that generate enormous trading revenues for banks. But privately, they're advising major clients to assume physical premiums are permanent. The bank's commodity strategists are also privately warning about the China problem getting worse before it gets better. The geopolitical tensions that drove Chinese export restrictions in 2025 are intensifying in 2026. Trade disputes, technology transfer restrictions, and strategic competition mean Beijing has no incentive to resume normal silver exports to Western markets. China is building domestic strategic stockpiles of critical materials, including silver. They're prioritizing domestic industrial use and sales to Belt and Road partner countries. Western buyers are at the back of the line. This fundamentally changes global supply dynamics in ways that paper markets haven't priced in. Internal bank forecasts project that Chinese refined silver exports to North America and Europe will remain 40 to 60% below 2024 levels throughout 2026 and potentially into 2027. This creates a structural supply deficit that can't be solved by increasing mine production because most silver refining capacity is in China. Wall Street also knows that the solar industry's silver demand is about to accelerate dramatically. Government mandates for renewable energy means solar panel production must increase by 25 to 30% annually for the next 5 years. Each percentage point of solar production growth requires roughly 7 to 9 million ounces of additional silver annually. The bank's industrial analysts have modeled this and concluded that silver supply can't meet projected solar demand plus existing industrial uses plus investment demand. Something has to give. Either solar production misses targets, or silver prices rise enough to force design changes that reduce silver content per panel, or prices rise high enough to crash investment demand. Any of these outcomes mean significantly higher silver prices than current COMEX futures suggest, but Wall Street's public research doesn't mention these supply-demand imbalances because doing so would validate the bull case for silver and undermine their short positions. The most revealing internal analysis involves the bank's assessment of their own trading positions. They know they need to reduce short exposure to precious metals over the next 12 to 18 months, but they can't do it all at once without causing a massive price spike. Their strategy is a slow, managed retreat. They'll cover some shorts when prices dip. They'll avoid adding new short positions, even if prices rally. Gradually, over many months, they'll reduce exposure. But this means they'll be buying instead of selling on price weakness, which prevents the major corrections they use to engineer. For silver traders, this means the pattern of the past decade is over. Wall Street used to cap every rally by aggressively shorting. That's not happening anymore because banks can't afford to add to positions they're trying to exit. The result will be higher highs and higher lows as the market trends upward with less resistance. Wall Street's internal risk assessments also flag the possibility of a real short squeeze if geopolitical events or supply disruptions create another delivery crisis like Friday the 13th. If major investment funds or sovereign wealth funds decide to take large physical positions, the banks don't have the metal to deliver and can't source it quickly enough. In a worst-case scenario that bank risk managers are modeling, prices could spike to $150 to $200 in a matter of days if a large buyer demands immediate physical delivery of 50 to 100 million ounces. The banks would have no choice but to buy at any price to fulfill contracts or face default. This tail risk is why some banks are quietly approaching large clients about unwinding physical delivery options on existing contracts. They're offering premium payments to convert delivery obligations into cash settlements. It's expensive, but it's cheaper than facing a delivery crisis that could push prices to levels that cause insolvency. Wall Street will never publicly admit any of this. Their official position remains that silver markets are functioning normally, prices reflect supply and demand fundamentals, and futures markets provide efficient price discovery. But behind closed doors, they know Friday the 13th revealed a broken system that can't be fixed without massive losses for the banks that profited from it for years. The real story they won't tell is simple. They were wrong, they're trapped, and they're trying to minimize damage while hoping retail investors don't figure out what actually happened.